Hello, my name is Michele, and you're listening to Profit is a Choice. On the podcast today is Shauna Wekherlien, lovingly known as the Tax Goddess. She is in the top 1% of tax strategists in the United States, and her clients, after using recommended tax strategies, they pay on average 6.9% in taxes. I know many of you, that's probably already getting your attention, right? So on our podcast today, we're going to talk about tax strategy. We're going to talk about the difference between a CPA and a strategist. And we're also going to hear about the IRS Dirty Dozen. So you don't want to miss it. Every day, empowered entrepreneurs are taking ownership of their company financial health and enjoying the rewards of reduced stress and more creativity. With my background as a financial software developer, owner of multiple businesses in the interior design industry, educator, and speaker, I coach women in the interior design industry to increase their profits, regain ownership of their bottom line, and to have fun again in their business. Welcome to Profit is a Choice. Hey, Shauna, welcome to the podcast.
Hi, I'm so happy to be here. Thank you so much for inviting me.
You are so welcome. So, Shauna, you have a designation that many people don't have, like in the top 1% of tax strategists in the United States. So that's exciting to be able to have some of that conversation around that. But before we jump into all things tax strategy, which is kind of where we're going to go today, I'd love for you to just take a few minutes and share a little bit of your business journey so that the listeners can get to know you and to know kind of your history and, how you got to where, honestly, you have such a love for tax strategy.
I love it. I love telling the story. So thank you for asking. I'm super excited about that. So I actually started in astrophysics, not anywhere near tax, not even close. I guess math, a lot of math. Let's go with that. But the very long story short, so here I am, I'm in college, astrophysics is the path. I was going to work for JPL, Jet Propulsion Labs. That was my dream ever since I was little itty bitty, right? And the long story short, I went home for breakfast. It was summertime, I think. I was having breakfast with my mom, sitting across the table, right? And normally she is a very stoic, very, centered kind of person. And we're just kind of talking, and she's opening the mail, right? And she throws down this piece of paper and pushes back from her desk. And this is ridiculous. I mean, whoa, hi, okay, what's going on? Are you okay? What's happening? I got another letter from the IRS, and I've paid these people, and they're looking for more money, and this is just ridiculous. And why do I have CPAs and attorneys and all these people advising me if all I ever do is pay tax, lots and lots of taxes, right? And she was so upset. And for me, my mother is my goddess, right? Everybody calls me the tax goddess, but she's my goddess, right? And so it was very upsetting to see that. And so long story short, over 3-4 years, I started switching into more accounting classes, finance classes, tax classes, right? Because this interaction was in my head. And the words she said, just why am I paying professional advisors if they can't help me? Right? Every time I go to them and ask for strategy, well, we're doing the best we can do. Obviously not, right? There's got to be something else. If you're getting notices, you can hear me. I'm even getting worked up about it, right? If you're getting notices from the IRS, this is just not, something isn't right. Something's not going right, okay? So very long story short, switched from astrophysics, switched into accounting finance, got my CPA, my master's in tax, specialized, all the way through CTC, certified tax coach, and CTS, certified tax strategist. So over now, 24 years that I've been doing tax, specifically tax, now ranked in the top 1% in the country. And, I'm thrilled because, of course, now our average for our clients is about 6.92% in tax, and that includes my mother. So I am very happy. But that was really the push off for that, right? Is I am a big I'm a big proponent. I'm a big believer that small business, she's a small businesswoman, general contractor, right? Small business is the backbone of our country. And if they are paying tax, they can't create jobs. They can't help us invest. They can't build the strength of the US. And I love my job because my job is to keep their money in their pocket and not in the government's. So it's a little bit of back.
Yeah. And it is so hard. What a fun story. Isn't it interesting too, how our family and watching and seeing how those things impact us, even in ways that we don't recognize until years later. And certainly seeing the pain that your mom was in at that moment, right? Yeah. Not just monetary financial pain, but also in an emotional pain. I mean, and a distress. It's interesting because we want to be able to trust the advisors that we're working with.
Of course.
I just had a conversation on a podcast earlier about how to choose a coach and how do you really trust these people and what have they done, and have they done what they say they're going to do, so that you can build this trust and vulnerability so that you can share. And it's the same with our CPAs, with our tax strategists, our financial advisors, and honestly, in some ways, very much more so because, as a coach that coaches financials, money is a really difficult thing to talk about. But I know from working with a lot of people over the years, they might be having companies that make great money, and they may have great money at the end of the day in their net profit, but we're taking 28 and 30% of that in many cases and handing it off between state and federal taxes. And in some cases, 40 and 50% based on the state that they live in.
63% is the highest rate in the country, and that's in California. So yeah.
Right. It is then hard. And so then the conversations that we have are something along the lines of, why would I make X amount of money if for every $100 I've got to give somewhere between $40 and $63 away?
Yes.
And on the let's say 37% that's left from 63, that 37%, I've got to find a way to run the company and pay myself. It's ridiculous. And so for some, they even hit that moment of, I don't even want to grow anymore. To your point,
why would I work harder?
Grow? It's going to cost me more, right? It's going to cost me more to be more successful. Now, I'm going to say this. I'm a Profit First certified coach. And one of the things, have been since 2015. And one of the things that we talk about is we do have to pay some amount of taxes.
Yes.
When we're profitable. So yes. I am not the coach that would ever tell people the goal is for you to always get down to a zero sum, meaning a zero net profit so that you don't pay taxes. That's not a tax strategy. That's not the best tax strategy, to have no profit so that everything's a break even. I don't care what somebody tells you. That just doesn't even make sense. So we know that there's some tax implication to success. The difference is we want to minimize it so that we can, like you said, reinvest, build wealth. I don't know a lot of small business owners that are just raking in the dough and rolling in it, right? Like crazy, because most people are going back and how can I rehire? How can I build?
You're trying to expand. You're trying to grow.
They're certainly making healthy livings, right? I'm not talking about that, but I'm talking about, I don't see the excesses that some are fearful that we will have if we make money. And so let's talk about, if you don't mind, I'd love to talk about why it's okay to be profitable first and foremost in the company.
Absolutely. And I'm giving you heart signs and smiles, and I love it because I also follow Profit First, and I love Profit First, and we teach all of our clients Profit First. So absolutely in love with that. Why is it okay to be profitable in the company? Listen, you have to make a living. Right? If you weren't making a living, I truly believe that there is a difference in the world between entrepreneurs and W-2 folks. I really do. They're just two different animals. Okay. W-2 folks, they want to go to work 8 to 5, 9 to 5, whatever it is, right? Do their job, leave the job at work, leave, go home, go hang out with the kids. Entrepreneurs are a completely different breed. We will work 24 hours a day. Not because it's our choice, because we have to. There's something driven inside an entrepreneur that you have to. building and growing and changing and modifying and improving. And I mean, all of these things, it's just a drive. It just is. And whether you're a W-2 high earner, right, you're making great money, right, or you're an entrepreneur, one of my favorite things about the US tax code is that when the laws are written, they are written for all of us. All of us. So it's not just this set of laws for the senators and Congress people, and this set of laws for the entrepreneurs, and this set for the W-2. The laws are the laws of the laws, period. Right. So I am all about making profit, but I'm also all about you keeping it, right? For whatever reason you want to use it for, whether you want to buy a yacht for you and your family, if you want to hire 30 more jobs, it doesn't matter why you want it, but it's your choice. It's your money. You worked really hard for it. So being able to implement the laws that are available into your situation, rather than just saying, oh, I guess I made profit, I'm going to just pay 40% of it, right? Use the laws that exist, all above board, all legally, right? Red and orange do not look good together. Nobody's going to jail. We're not doing it, right? Yep. But use the laws that are there, use the laws that are available to you to keep your profit, to do whatever it is you want to do with your profit. So I'm with you 100%.
Yeah. And I usually tell my clients, my goal is to take you as close to the edge of what the tax laws say without pushing you over, right? We don't want to invite an audit. We don't want to do anything sketchy. So we want to be on the right side of it. But if it's there, we should be able to take advantage of it. But I see more taking advantage of things they shouldn't be taking advantage of.
Oh, well, you get the IRS's Dirty Dozen list. I mean, that gets published every single year. We use something called the aggression scale, and very similar to what you're saying, right? 0 to 10. 0 meaning the IRS is never going to call you never, ever, except for a random audit, because that happens. Okay.
That's right.
10 meaning we're all going to jail. Okay. So myself, tax goddess, or company will go to a level 8. Which is, listen, the IRS might call you, okay, but you have all the backup, T's crossed, I's dotted, you have all the things. So yes, they come talk to you, you show them the documents, they go, okay, and they stamp and they leave, right? So we'll go to an 8. A 9 in my mind is that was the Al Capone. You're doing bad things and hoping you're not going to get caught, right? So we try to stay away from the 9s and the 10s, right? It always cracks me up because you'll be talking to somebody and they're like, no, I'm a 20. And I'm like, I'm an 8. We're pulling you back, right? If you want to work,
right. If you want to work here, you got to stay in this.
This is what we're doing. Exactly. So, I think one of the questions that a lot of people, nobody's ever been asked that. You ask that as a professional. I ask that as a professional, right? But when we ask new people that we're talking to, okay, so what is your aggression scale? Nobody's ever asked me that. Okay, well, let's work through that, because if I don't know where you want to be, I'm an 8, but you might be a 2, you might be a 5, you might be a 20, and I got to pull you back, right? We have to know this answer. And I think it's one of the places where CPAs, financial advisors are better about it because they're regulated by the SEC. They must ask that question. But a lot of CPAs will get into a relationship with a client and the client never asked, and the CPA never asked. And so if you're an 8 as a client, but your CPA is a 2, they won't even bring you strategies that are a level 8 because they are a level 2. They're automatically putting a filter on what you're even going to hear about as far as strategies.
It's so funny that you say that, Shauna, because I've seen it both ways. Like I've worked with companies that were, I'm going to throw out a number. Like let's say that they are $250,000 net profit company. Okay. And they're not an S corp or filing as an S corp. And I'm asking them, why are you not doing that? Do you not understand that we can run some of the, how much do you take out of that in a year? Well, I take 175,000. Okay. Do you understand that we can run half of that through payroll and half of that through draws? And so you're only paying self-employment taxes on this piece. And my CPA says that that's too much work. I'm like, it's very easy. We just need to do this. You can go to the .gov. Like, here's what you do. It's going to, in some states, it's less than $100.
Here's one page and you're doing your thing.
One page, do it yourself. Make sure that you sign up, that you're an agent in your own state, and then go. Some states require a little more. Let's do some research. And they realize it's really not that big of a deal. And then I've got others where their whole net profit is 30,000 and their CPA is super aggressive. Like, you need to be an S Corp. And they're over here and they're hit with all the fees and the fines for, right?
But you
All
got to
the-
file tax returns,
all the
late
file
filing,
tax
everything
returns,
else.
right? The
Payroll.
Schedule Ks and the payroll and all these things. And they're like, I'm not even taking payroll. So they're not having those conversations in a lot of cases with, or like if the CPA says to them, I think it's time to go to S Corp filing, let me show you, this is what it looks like with, this is what it looks like without, here's where I believe the savings will be. Here are the additional costs, which is what doesn't come up. Here are all the additional costs of being it. Here's the tipping point for your business, for you, for your financial, understanding of you
100%.
and your partner. This is where it's right, because it can be a different tipping point. And so I love that you bring that up of even having that conversation. Our financial guy, how risk averse are you? How risky do we want to be? Like, we're having those conversations. They need to be had here. And I've seen people that when we look at their financials, they're like, my accountant's recommending this. I'm very uncomfortable with it. I'm like, then you need to tell them you're uncomfortable. It doesn't make
Say
it
something.
wrong. It just makes it different. And you need to voice that.
Yes. Yeah. Because guess what? Guess who's signing that tax return? Your CPA and you, right? So if you're not happy.
That's right. But not only that, I've noticed over the last few years, back in the day, you can correct me if I'm wrong, but back in the day, I remember when the reason I went to an accountant or a CPA to file my taxes is because they signed that they were verifying everything on that document. These days, I have to sign that everything on that document is verified and that they only use the numbers I gave them. So a lot of the weight shifted to the owner over the last few seasons of tax, where it used to sit squarely on the shoulders of the accountant or the tax preparer. I mean, not that there's not some responsibility for them, but you sign that you are the one. That's right. And so that means we need to know
You better know what you're
doing and
signing.
what we're signing. We can't like claim ignorance because we put our signature on it.
Yep.
I want to ask you, you said something a minute ago that was interesting to me, not something I've heard before, but I don't doubt it. You talked about the IRS's Dirty Dozen. Can you tell us what that is?
Oh, absolutely. Okay. And I'll even give you an example.
Yeah,
so every single year, the IRS looks at all of the tax scams that they have been focusing on, right? And so you get some common ones, right? For example, one of the big ones right now is something called a captive insurance company. Okay. A captive insurance company. Now this is what I love and hate about the Dirty Dozen list. Okay. Every strategy has a good version of a strategy and a bad version of a strategy. Okay. So captive insurance is a really good example of this. All right. I'm going to use COVID as the example. So here we are, all of us, the whole world, going along, doing our thing, making our money. Okay. COVID hits. Businesses stop, shut down, can't operate, no cash flow, lots of expenses, right? Everything just exploded. Okay. A captive insurance company, there's a bad version and a good version. The purpose of a captive insurance company is to insure against valid risks. Okay. Now, before COVID, a pandemic is not something anybody really thought. I mean, the last one was 1918. I mean, nobody really honestly believed that this would have been a valid risk. Okay. But we were obviously wrong. Pandemics can happen. Okay. So, example of one of my clients does catering for Major League Baseball teams. Okay, had just bought all of his food, $600,000 for the start of baseball seasons, February 2020. And nope, shut down. Okay, he had $600,000 worth of food spoilage because obviously he can't return the food, right? I mean, he bought it, it's done. He went to his main insurance company, Farmers, State Farm, whoever it was, and said, pay me. This is why I've been giving you premiums for 20 years, right? Pay me. They said, no, act of God, not covered. Okay. He also had his own captive insurance company that covered him. Guess what? He got his money out of his captive, valid claim, clearly a valid risk, right? I mean, this is a thing. However, you will notice that captive insurance companies are listed on the IRS's Dirty Dozen. And what they're looking at, so I'll give you the IRS's famous case for the Dirty Dozen side. There was a rancher, 5,000 head of cattle, okay, had gotten insurance through a captive insurance company, but had gotten flood insurance. He was up on top of a mesa, like on top of a mountain. There hasn't been a flood there in all of recorded history. So unless we start getting biblical level rains, right, that is not going to be a thing.
Right.
He lost the case for the captive insurance. His was considered invalid, Dirty Dozen, IRS Dirty Dozen level, okay, because he got insurance for something that would never, ever happen, okay? On the other side, COVID was the perfect example of an act of God. Now, an act of God could be anything. It could be a pandemic, a typhoon, a hurricane, right? A lot of the insurance companies will not cover acts of God. The captive will. So when you look at the IRS's Dirty Dozen list, right, and you've got a strategist, you've got somebody, telling you about this strategy, that strategy, whatever, sometimes you will see them on the IRS's Dirty Dozen list. It goes back to, you need to know, what is this? Why is it valid? Does this feel right to you? That aggression level thing, right? You need to understand, which strategy is it? How is it going to apply? And is it really valid for you? And you do have to have some level of trust with the professional team you're working with. And are they signing the tax return, or are you the only name on the bottom of that thing, right? And what is the backup and proof and help that they're going to provide you? So
let me ask this, the Dirty Dozen list, let's say the latest one, either 22, 23, whatever is out for right now. Is there anything else on it, Shauna, that you think would be applicable to the interior design industry or to small businesses like what we have, that we need to be aware of? What else is on that list that we need to have a deep breath about?
I actually, and I really do like the captive, because the captive applies to anyone making gross revenue of 750,000 or more. So that's always, one of the big ones.
I've never heard of captive insurance.
So sometimes it's going to be called an 831B. Some people might hear that term, 831B. Yes. Captive insurance tends to be the more big picture name for it. The other one that we see quite a lot, and this goes to the high income filers, charitable remainder annuity trusts, a lot of charity stuff. Let's kind of phrase it as charity. We see people trying to set up private foundations that don't ever donate to anything, right? Like, they're just running everything. You get one of the most popular ones right now is a trust that, you hear this phrase, own nothing but control everything. Okay. That can happen, but you are literally giving up control, you're giving up assets, you're giving up income, right? And so where we see these scams come out is people that say, oh, yeah, we're going to put everything into a trust, but you still get all the money, you still get everything, but you don't have to pay any tax. Yeah. So it's one of those things, and this is where it becomes this fine line between tax strategy and a scam. Okay. Our average is 6.92%, but that is a combination of over 400 tax strategies that we apply to any specific case. So where I tell people really to watch out with these Dirty Dozens is when you get somebody that says you need one strategy and you'll never pay tax ever again. Yeah, world doesn't work that way. It just doesn't, right?
Yeah, that's a good point. So this is really about a layering, if you will, of tax strategies. It's not the thought that came to my mind. The thought that came to my mind when you were describing that, Shauna, was, if it sounds too good to be true, it's probably too good to be true, and probably illegal. There's a scam involved in there.
Yes. Well, and I think,
go ahead.
I think one of the biggest things here, right, is okay, listen, if you're paying $100,000 in tax, okay, a good tax strategist can help you wipe that out. No problem. That's very easy for us. Okay. But you will do a lot of work. There's a lot of effort that has to go in. You have to set up this structure, that structure, this, you have to move money. You have to pay attention. Okay. That, in my mind, is the valid side of it. You're going to get a benefit, but you got to put in work, right? Those two things, in my mind, always go together. Okay. So when you hear somebody, that magic bullet, oh, all you have to do is sign this one piece of paper. all, really. That's it. You know, kind of like you were talking about with the S corp thing. It's not one piece of paper. It's one piece of paper plus tax returns and payroll and right.
That's right.
So you can get the good version of any strategy and the bad version of any strategy.
Yeah.
And in my mind,
I think that's important. And it's funny that you say that, because I've looked at a couple of different things and listened to a couple of different conversations, and it's always, there's work to be done on the part of the business owner. And so then you need to set this up, and you need this document, and you need that. And sometimes we can actually look at all that and think, oh my gosh, I'd rather just pay the money. I don't want to have to do all that.
is it worth it?
Is it worth all that?
Yes,
Right.
yes.
And so
100%.
I do think there is absolutely, let me back up and say it this way. Whenever somebody listening is talking to their tax strategist, their CPA, whoever they're listening to, when a strategy is presented to you, I think a really great thing to do would be to say, and what does it require of me? Because if you don't know the other side, it's the same as moving to an S corp too early and not understanding you're paying thousands of dollars more for all the tax stuff, so that you're actually not saving the money that you thought you're saving it in taxes, but you're paying it in a bunch of other fees. And so really knowing both sides of the equation, even putting things into a trust. What am I putting in and what am I not getting over here? I know we took advantage of conservation easements one year. And the thing about those is that's great until it's not. And the government decides they don't want to do those anymore.
They're on the Dirty Dozen list now.
I know. But you know, 1 year they're not, and 1 year they are. You don't know. And a lot of this, I'm just going to say this from my own perspective, a lot of it changes based on who's in the White House and who's controlling Congress, because the tax laws change all the time. So what's on a Dirty Dozen list at one point may not be later.
Oh, yeah.
So again, just saying there's work that comes out for all of this.
And it's why you want a specialist, right? So yes, I am a CPA, right? I'm a CPA, master tax, blah, 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 blah. Okay. But I don't do tax returns. I mean, we'll do them if you really, like, if your CPA is a level 1 and you're a level 8, like, fine, we'll do your tax return for a couple of years, right? Like, just to get everything sorted and get everything settled, and then we'll get you to a CPA, right? But we specialize in tax strategy, and we do that because the IRS changes the rules 3 times a day. So if you're a regular CPA, and we love regular CPAs, they file tax returns, they protect you, that's their job, they give you day-to-day guidance. But if your regular CPA calls themselves a tax strategist, where are they finding the time to read the 3 times a day federal changes, let alone all 50 states, which normally, depending on the state, is either once a day or once a week. So if
it's crazy.
You have to be up to date. Because we'll pick on that conservation easement, right? Difference between a conservation easement and a syndicated conservation easement. If you've got a syndicated one, you better go back to your CPA right now and find, okay, so what are we going to do? Because it hit the Dirty Dozen list again. This is now the 3rd year in a row. Syndicated conservation easements have hit, and the IRS is out hunting, right? That 87,000 agents, they're looking at that Dirty Dozen list, right? So. Sorry, you got me on a little bit of a rant there. Sorry.
Yeah, no, it's good because again, here's the thing that I'll say too. And you, again, provide insight if I don't express this properly, but when we make some of these decisions with our tax strategists, we also need to realize that some of these decisions are not 1-year decisions. They are decisions that have a longer term implication. So if we are at an 8 now, but we believe in 2 years, we're going to be at a 6, we need to think about that 8 decision, because it could outlast us getting to the 6 of comfortability. Does that make sense?
100%. Yeah. When you look at, so when we build tax strategy, we start we talk about the aggression scale. Next thing is, what do you want in the next 5 to 10 years? Are you building the business? Are you selling the business? Are you buying rental properties? Are you putting kids through college? Like, what are you doing, right? What is the life? Because yes, I can absolutely plan for today. However, if next year you're selling the business, well, that knocks out this, and this. I can, but I shouldn't do this, and this, because it's going to impact negatively now the following year, or 3 years from now, or 5 years from now. So yeah, I really, honestly, deep down, I feel like one of the biggest pieces that a traditional CPA misses, right, is a lot of people walk in and say, great, here are my documents. Here's my stuff, file my tax return. There's no conversation. There's no aggression level. There's no, where are you going over the next 5 years? Not a lot of people are lucky enough to have a CPA who actually knows their situation, who knows their family, knows where they're going. And even if they have that CPA may, I don't want to say only be a CPA, but only be a tax
Focus.
CPA.
They may focus on
focused.
tax prep.
Exactly. So, really, I always look at it as a three-legged stool, right? Always, right? You have your day-to-day bookkeeper who's doing the books, payables, like all the day-to-day stuff, right? You have your CPA whose job it is to file the tax return, make sure you're not going into jail, right? Not being thrown to jail. And then you have the strategist. And without one of those three legs of the stool falls over. You've got to have all three pieces. So.
Right. And I would almost say a fourth leg to that stool is you're a financial advisor.
Oh,
right?
for
So
sure.
that then
Absolutely.
they're taking all that savings that we got from the
And doing
strategist
something.
and investing it to go forward.
Yes.
It really is. And, let me ask you this, because I think some people listening may be thinking to themselves, I'm just starting out in business. I'm just earning my first 6 figures or my first few 6 figures, right, in revenue. My profits aren't huge right now. When is the right time to reach out to a tax strategist? I mean, some people are thinking, I don't even need to talk to a coach yet. Sometimes that's when you need to talk to them, is when you don't know what you're doing or when you don't have a lot. But when is the right time to reach out to a strategist?
100%. So I am a big fan. I'm going to come at it from, we're little, we're baby, right? And we're growing. Okay.
Yeah.
I'm a big fan of just knowledge, period. Always ask questions. Now, I love TikTok. I spend at least half an hour a night flipping marketing, tax, finance, whatever, right? TikTok, YouTube, I don't care where you get the education from, right? But educating yourself, at least in general, so that you know what kind of questions you ask. Okay. So I would always start there, whether you're already making $1 million or whether you made your first $6,000 sale, like whatever it is, right? Always, the more education you can have, the better. Now, each tax strategist, there's only 607 people in the entire country that do what I do, right? So each tax strategist is going to have a very different specificity and what they're looking for, okay? In general, I think across the board, most tax strategists are not really going to be cost effective for you until you're paying about $100,000 a year in tax, okay? So the basic strategies, earlier, before we got on, we were talking about the low-hanging fruit, okay?
Yeah.
Your basic strategies, okay? Paying your kids, converting to an S corp, writing off your dog, doing the master's exemptions, these basic low-hanging fruit kind of strategies, those will handle up to about that $100,000 of tax limit, okay? Now, $100,000 tax, if let's say we're at a 30% bracket, right? That's really about $300,000 of profit, 350, somewhere in that range. Okay. Once you get above that, now you're looking at what I call big boy strategies, right? So we're looking at things that are going to wipe out in a single move $100,000 of tax or $80,000 tax, things like that. Now, I will say there are some people I don't want to mess around. I want to know from day one, right? How do I do it? How do I structure it? What am I doing? Right? Those people, when you think you're ready, when you want that, reach out to a strategist. Absolutely. Okay. But a good, basic, solid CPA, I would ask the questions about aggression. Make sure at least you're on the same page about aggression, right? And I always use the 4 that I just mentioned. I always use those as tester questions, right? When somebody says, well, I don't know if my CPA knows the low-hanging fruit, right? I use those as tester questions. Hey, so I saw on TikTok that I can write off my dog. How do I do that? See what their answer is, right?
How do you write off your dog? I have never heard of that in my whole life.
Oh, sister. Oh, it's my favorite thing. So, okay, so let's back up. I have 4 German Shepherds, right? So they're big, right? They're big, big German Shepherds. So let me give you the rules here, okay? That's my favorite deduction ever.
I'm shaking my head. Like, I'm just like, oh my gosh. Okay.
Hello. Okay. Now you did tell me that you've got little 4-pounders. So
I
we're
do.
going
I
to
have
have
little 4-pound dogs.
little 4-pounders. So this will be a good difference in description here. Okay. So the technical rule for writing off your dog, there's different versions of writing off your dog. Okay. You can have medical dogs, right? Like you've heard PTSD dogs or glucose dogs, these kind of things. Okay. Those are specially trained. They're medical deductions. That's pretty clear. Okay. For the rest of us that don't have a medical dog, you're looking at 3 qualifications. So the first one is the dog's shoulder must be taller than the height of your knee. So unfortunately, your little 4-pounders are not going to qualify, but my German Shepherds certainly do, right? Big puppies. Okay. The second one is that they must be trained. Now, this was very vague in the court case with the IRS. Okay. They just said trained. So trained means sit, stay, come. I mean, trained for what? It's very vague. It just says trained. Okay. So we normally follow sit, stay, come. Okay. The third one is the dog has to be used in some sort of business purpose. Now, this is where we see a lot of TikTok dogs. We see a lot of YouTube dog stars, right? But you also see security dogs. So in my case, but like I said, 4 German Shepherds, right? I invite a lot of clients to my home for dinners, for business meetings, for brainstorming sessions, whatever it is, right? Well, those dogs are my security. If anything were ever to happen, right, they have a business purpose. They're with me in business meetings. I actually had to lock them out so they weren't with me here for today's filming. But yeah, they have a business purpose. So most of my clients will write off their dog if they meet those 3 qualifications. So shoulder and knee, right, height requirements. They have a business purpose. And of course, they're somehow trained. Write them off as either security dogs, it could be advertising. If you can prove that you got a client because of the dog, advertising, marketing. So there's lots of different ways to write off the dog, and it's really going to be very specific to your situation. It's part of the reason why as strategists, we want all the details, everything. I want to know how cute those 4-pound dogs are. Yeah. Oh, it's great.
That's crazy. So what, for the designers listening, workrooms, we have builders and architects for businesses that are listening today. What are some of the tax strategies that they might even just want to be aware of that maybe aren't so common? Or even some that maybe are common, like that. Maybe that's common. I've never had a conversation about writing off a dog in my life. Now, I'm not a tax strategist. I'm not a CPA, so that's not a rule I've kept up with. I've heard of things like an Augusta rule. Tell us.
I was about to say that the master's exemption or the Augusta rule, it kind of goes by both names.
Yeah.
And I'm
I'm in Georgia, so
I was about to say, yes, I was just about to say, you would know exactly what this is about when I explain it. So my favorite bit about this rule, okay, so the story, obviously the Masters tournament held in Augusta, Georgia, right? So it's why you get both names, Masters or Augusta. So effectively what this is, if you own your house, now you're allowed to have a mortgage, okay, but if you own it versus renting it, so it does not work for renters, you have to own the property, mortgage is fine. You are allowed to rent your home to anyone else, asterisks right there, to anyone else for any reason, and whatever amount of rental income that you receive up to 14 days a year, so up to and including 14 days a year, all of that rental income is 100% tax-free, period. Okay. Now I put that little asterisk there because a lot of people are like, oh no, I've heard the horror stories about Airbnb and they trash your home and they pull the copper out of the walls and like, I don't want to rent my home. You just have to rent it to someone else. So your business, LLC, S Corp, partnership, C Corp, whatever, is somebody else in the eyes of the tax code. Okay. So what you can do, as I mentioned, I invite clients over, we do masterminds, right? I am renting my home to my business instead of going out and renting a conference room, right? And my business pays me rent for the use of this space. Now, the coolest part about this, in my mind, 14 days a year, okay, the rental rate for your space is based on where you are. Okay. So across the country, we deal with clients all over the US. We deal with clients outside the US, as long as you're a US citizen paying US taxes. They look at where is this conference space? Okay. So I've got clients that live dead center Manhattan. Their conference space is expensive. super expensive, right? For about a 300 square foot space, rental rate is $17,600 per day. Okay. Well, 17.6 times 14 days, now I'm going to run that number times 14, is 246,400 tax deduction, tax-free income to you, cash you can just take out of the business every year for 14 days. Okay. Now, not everybody lives in Manhattan, right? The smallest rate that I've ever seen is about 500 per event. That's still $7,000 that you can take completely tax-free, cash for you out of your business every single year. So it's one of my favorite deductions because—
So is that, so even like if we were an LLC and we were home-based LLC.
Now there's a couple of qualifications here, right? And this is why you make sure you always follow the rules and what are the things.
Sure.
If you were an S Corp, so LLCs are the legal setup. And so this is talking about the taxation types. Okay. So an LLC can be taxed as an S Corp or taxed as a partnership. Okay. So an S Corp, a partnership, a C Corp, that is separate taxation from you. You can just do this. You don't have to do a 1099. You don't have to do, there's nothing else you have to do. It's just 14. You pay rent. Make sure you pay the rent. Like actually, I help this event pay the rent.
That's that part of right here it is, but you actually have to do it.
You got to do it. Yeah. Transfer the money. Okay. And I'm so sorry, side tangent, because everybody always asks this question. Well, what if I don't have the money? Like, what if I'm just starting and I need the money in my business? You can pay rent and then put the money back in as a loan. That's fine, right? But the money has to move. If it doesn't move, you've got a problem. So S Corp, partnership, C Corp, you're totally fine. Okay. With an LLC that is, or with anything that is taxed as a Schedule C, okay, you have to be a separate legal entity. So if it's just you and you don't have an LLC, that's not going to work, right? Because you are
complete sole proprietor.
Complete sole proprietor, no LLC, no nothing. That's not going to work for you. Okay. There's this middle category, which is an LLC taxed as a Schedule C. Okay. Now, this is where it gets a little gray. So this is probably a 7-8 if that's your category. Okay. If you're this category, it's a 0. If you're S Corp, C Corp, partnership, it's a 0. Do it. You should be doing it. Absolutely. If you were an LLC taxed as a sole proprietorship, you can still do this. Absolutely. Okay. But you have to the business has to give a 1099 to you as an individual. On your personal tax return, you have to report it as income on Schedule E. And on Schedule E, you can then report it as non-taxable under the master's exemption. So there's a very particular, and if you don't know how to do this, find a strategist, okay? Because if it's not done right, the IRS will take it away. So.
Yeah, that's really good to know. I've seen people that I've had a client out in California that somebody wanted to come in and film. She's an interior designer. Her home is beautiful. They wanted to come in and film. They brought some people in for a couple of weeks. They, her family went on vacation. They rented the home. They did what they did and they walked away. So I love that. What are some other just things that maybe we haven't thought about that would be some of those types of things for people to look at?
Absolutely. Okay. So the next one is paying kids. And I don't know if I never want to cover something again that's already been covered.
I would love for you to go deeper. Like we've had on the podcast, people mention covering their kids, but there are some, the kids actually need to do something. They don't need to.
They do need to do something.
It's kind of like the dog, right? It's kind of like the dog. There has to be a purpose. I'm not saying people's kids are dogs. Please don't write in.
No.
That's not what I'm saying. I'm saying it's further than just being your child. So share what the rules are. And honestly, what I'd like to hear is even what age is appropriate to start, because I hear so many different things.
I was just about to say, let's start with that one, because that is one of the biggest key factors here. Okay. Now there's a general rule and there's a specific rule. Okay. The general rule is that you cannot pay your children until they hit the age of 7. Okay. So 7, the day they turn 7, if that's June 1st, right? And they turn 7, you can start paying them on June 1st that year. It's the day they turn 7. Okay. That's the general rule. Now, my favorite of one of the specific rules. Okay. You can pay children that are less than 7. And I want you to physically watch my hand here, because this is actually very important, but they have to be very, 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 5 varies cute. Very, 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 very cute. Okay. Now, this language actually came from a court case, okay, where you had parents who were using the baby, right, the brand new born baby. They were paying the baby wages. They were paying the baby wages for being a model, okay, for, being on the flyers and the brochures and, all this kind of stuff. Okay. Obviously, we have the Gerber baby, so you can do this, right? But the court literally 5 varies. Very, 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 very cute. Okay. Now, my favorite question from clients is, well, how do I think my baby is 5 levels of very cute, right? But how do I determine if anybody else thinks the baby is 5 levels of very cute? You would literally have to go to a modeling agency and get them to approve the baby to be that level of cute, right? To be a baby model, to be able to do that. Okay. So with most of my parents, I'm like, listen, I know you think your baby is cute. If you really want to, go ahead. Okay. But otherwise, no. 7, just start at 7, right? That's the baseline. It's much easier. Okay. Now, once you've decided, okay, great, they turn 7 today, they turn 7 and we're on, and this is what we're going to do. They do have to have a job. Now, the cool thing about the way that this rule is written, you are allowed to pay a child the same rate that you would pay a professional for that industry. Okay. So for example, if your child was sweeping the floors, shredding papers, putting away the coffee mugs, whatever, well, that's an admin or a janitor. So we might be talking $20 or $25 an hour.
That's exactly what I was thinking. Yep.
Yeah. Now, when your kids get a little older, so now they're 12, 13, 14, whatever, they can now run your social media, right? Because kids that age, like, they know a lot more than we do about how to run it. And here's the TikTok video, mom, like whatever, right? Social media managers run about $120 an hour. So depending on the job, depending on what you're having the kid do, the rates can change, the dollars can change, the job description can change, all these things. Now, the other side of this, so they do need a job, they need to track their hours. Now, you can pay them by project. So you could absolutely pay a 7-year-old to model on a brochure. They don't have to meet the 5 very cute levels, right? Because now they're 7, so this is fine. So you might be able to pay $2,500 per photo shoot. So if you're doing photo shoots of locations that you've done interior design or built or whatever it is, right? Put the kid in the photo. Great, $2,500 per photo shoot or something along those lines, whatever that is. Okay. Now, the other thing to note here is that, and of course, these rates change every single year. So right now it's 2023. The maximum that you can pay a child and have them have no tax and you have no tax at the moment is $19,850. Okay. And that's really made up of 2 different numbers, $6,000 going into a traditional IRA and the other $13,850, which is just non-taxable at all for anything. Okay. So a lot of our parents will say, well, okay, I've got 3 kids. They all need it. I don't have $60,000 to just hand over to children, right? The one thing I love about the money that you hand to kids, and depending on how you feel as a parent, okay, you can either give that money to the financial advisor, say invest, grow it, right? Because the compounding from a 7-year-old, right? I mean, amazing. So you can hand it to the financial advisor, or the children are allowed to use, because it's now their money, right? You are allowed to use their money to pay for anything that is not a parental duty. Not a parental duty. So not food, clothing, or shelter. But they have music camp, band camp, a new iPad. At 16, they got a car. They have insurance. They have cell phone. Not food, clothing, and shelter. Those are the only 3 things that you as a parent, you're not allowed to charge your kid rent for living in their bedroom. Like, I wish. Not gonna work.
Right.
So, yeah.
Wow, that's so amazing. That actually gives even more detail than just the broad idea of it. So that's really great. Shauna, is there anything I feel like we could talk for about 6 more hours. Is there anything as we're getting close to wrapping up that you think people really either need to know, understand, steer clear of, look further into with regards to tax strategy? Or is there just something that you want to share because you're like, this is super cool and you all need to know this?
I think I really do. I'm so glad we were able to cover the aggression scale, because really that is the key. That's the cornerstone of all of this, in my opinion. Okay. You have to be surrounded by a team that matches who you are. because you are the client, you are the center of the focus of the world from that standpoint of the team that is focused on you. So my suggestion would be think through that. Where do I really sit 0 to 10, right? 10 meaning we're all going to jail. 9 is Al Capone. We're just hoping we're not getting caught. 8, I'm okay getting an audit, but I'm legal, everything's totally legal. 7, I really don't want to talk to the IRS, but I still want to push the envelope. Or am I somewhere below that? Okay. You've got to make that decision. And then you need to be asking your team, CPA, where are you? Because if your CPA says 2 and you're an 8, even if you worked with a tax strategist and you and the tax strategist were a level 8, if you take it back to a level 2 CPA, well, I'm not signing off on that. It's not going to happen. Your team has to be in line with wherever you are. So out of everything that we talked about today, I mean, lots of strategies and lots of options. And guys, these are low-hanging fruit, right? Lots of things to do. But that aggression scale, if you're not clear and your team isn't clear, you're leaving money on the table. So
one last thing. How do tax strategists get paid in general? Is it a by the hour, by the project, a percentage of savings? How do they, and I know everybody is a little different, but
Yeah.
what would you say people can expect if they've never worked with a strategist before? Yeah, to just know how this is going to play out.
So you bring up, and I'm going to answer two different questions that you asked but didn't ask. Okay. So one of them, the first one is, as a CPA, okay, it's actually illegal for a CPA to charge a percentage of savings. So I want that to be really clear. So if you're working with somebody that says they're a CPA and they charge a percentage of savings, that's illegal because it incents people to do bad things, right? It incents me to put you into a dirty dozen and, oh, I saved you all this money and then I'm gone, fly by night. Okay. So step one, I would absolutely recommend that you're looking for the CPA combination with the strategist, right? Those two things. But so if anybody's trying to charge you a percentage of savings, think twice.
Run.
Yeah, right. Thank you. Run. That was,
Run.
yes, run. Yeah.
I can say it. Run.
Thank you. Run away. Otherwise, there is absolutely, some people charge hourly, some people charge a flat fee. With us, we prefer to charge a flat fee. So you know what it is. We know what it is. We have a minimum return on investment. Most of the strategists do. So for example, our minimum ROI guaranteed in writing is 3 times whatever your investment is. So the smallest tax plan that we've ever written was, I think it was about 14,400. The largest tax plan we ever wrote was 187,000, but we saved those people 112 million. So it's really just, who are you? How complex are you? Do you need 1 strategy, 5 strategies, 30 strategies? I mean, there's 400 plus just at the federal level, forget state and local on top of that, right? So, yeah.
Awesome. Well, Shauna, this has been super helpful. Lots to think about. Exciting. Tell everybody where they can follow you and where they can find you in online and social.
Oh, you're a sweetheart. I'm so glad to hear that it was so valuable. That makes me happy. We are super easy to find. Tax Goddess anywhere. Facebook, Instagram, website, YouTube, that free education, guys, where I was telling you, make sure you're watching education. We film a video at least once a week. Our YouTube has hundreds, if not thousands of videos on pretty much any topic you could want. So I would start with that education. But yeah, Tax Goddess, we're super easy to find.
That's amazing. Thank you so much. And thank you for sharing and for making it approachable, right? And relatable. I think that's so important because sometimes when we're talking finances and taxes, it feels hairy and scary and nasty. And there are parts of it that really are, not going to diminish
Absolutely.
that. But it also is something that we can get our arms around if we have the right people on our team. So thank you so much.
You do not have to be
for being the right person on the team today.
Oh, you're a sweetheart. I was going to say, you do not have to be a super genius to save money. You don't.
That's right.
Right. So it's okay. Yeah.
Awesome. Well, thank you again.
Thank you so much for having me.
Shauna, thank you so much for joining us today and talking about tax strategies, how to get started, even about the Dirty Dozen. I know I learned a lot on the call today, and I hope that others did as well. If you want to know more about working with a tax strategist or Shauna in particular, check her out at taxgoddess.com. You can also check out working with us over here at Scarlet Thread Consulting, where we can help you build a strategy for your business. And we would love to do that. You can sign up for a call with us by going to scarletthreadconsulting.com and going to the Work With Me page. I'm going to suggest that we are being very intentional about our profitability and about our tax payments, because profit doesn't happen by accident.
Profit is a Choice is proud to be part of the designnetwork.org, where you can discover more design media reaching creative listeners. Thanks for listening, and stay creative and business minded.